right? As long as there's not a mass exodus of the angels, if one angel's like, look, I'm getting divorced or something, great, I'll pay you, 2, 3x on your money or whatever. So, and that means that your portfolio gets positive quickly too. And then another benefit of this kind of strategy is that let's say you have $250,000, right? Would you rather do one investment at $250,000 or would you do 5 at $50,000? It's funny, everybody agrees. Everybody always agrees. They say, like, I should do 5 deals. That makes sense. Yeah, that makes sense, right? But then in reality, everybody behaves differently. The number one mistake early stage investors make is they write too big of a check at the beginning. That's the number one mistake. Number one mistake. The other thing is bad bets fail fast, right? 50K, you give somebody 50K or even 5,000 bucks, right? You let it die. So even here in India for whatever, you should be doing $5,000 or $10,000 checks to start with. Just get yourself a seat at the table, see what happens. Use 100 grand, give it to 20 companies, right at 5K a pop, and just see what happens. That's a better use than giving 100 grand to one investor. Because the guys that you want to ultimately invest in are the ones that could do a lot with a little anyway, right? So again, failure rates are high. For the angels in here, this is how I would ask you to think about running your own portfolios. This is how I operate mine as well, is that, in my fund, I allocate 30% of, so some of you I can see are mouthing, like, how did I come up with that number of $50,000? That's actually the number that I use. So I do 250 deals, initial deals, on an average check size of $50,000. And that adds up to about 13 million or so, right? That's typically around 30% of my fund. 70% of my money is actually allocated for just follow-on in the winners. And roughly for the angels in here, if you agree with me on that quantitative stuff, you must do 10 to 20 deals. You use 30% of your capital to invest initially into 10, 20 deals. And then what you do is you use 70% of your money to go into the top 20% of them. And if you're really good, what will happen is there'll be a little phenomenon that happens where other people index your market, and you'll have to break they'll index your portfolio, and you'll actually have to break this into 3 tiers. And what I mean by that is that, like, if you're good, other people are going to overfund your companies, and in order to, like, preserve your position, you're going to have to invest a little earlier. That's a first world problem, and when you have that problem, I'm happy to tell you how to fix it, because we're dealing with that as well. So let's jump quickly into deal terms. I'm happy to jump into this, but given time, I want to skip it. But does everybody understand the difference between debt and equity? No? Okay, that's okay. That's good. So here's the bottom line. Debt is effectively a loan to the company, but without any sort of collateral. Okay, so you do not expect to get them. Any time you invest in a startup, you will not get your money back. And if you actually ask the founder to personally sign for it, you're already in trouble. Don't do that. Just don't do that. So debt is a convertible note. It's effectively like a loan to the company, but it can never be repaid back. And equity is you're buying direct shares in the company. One of the material differences between the two from an administrative standpoint is that I'm going to just make a statement and just say equity typically costs about 10x in terms of legal fees as opposed to debt. And the reason is because there's a lot more, at least in the US anyway, once you do an equity round, you trigger a lot of compliance requirements with the Securities and Exchange Commission.
Are you guys doing the same thing in India when doing equity versus debt in terms of legal fees?
Well, I use my US counsel. But in general, though, that 10x number does hold. Yeah. I kind of joke. Do you guys have Costco here?
No. We have Metro.
Metro, okay. I always joke in the U.S. anyway that we're the Costco of startups because, like, our legal fees are, like, we have it averaged down to $2,500 a deal. But it's like in India, we're the Metro of startups. It's Metro, right? Yep. We're the Metro of startups. So we just do a lot of deals, and so our average cost goes down. But you should generally plan on spending about $5,000 per deal. It's just a average. I don't know what it'll be in India, but we use U.S. counsel for all this. But look, convertible notes are okay, is the point I want to make to you. I don't understand why Indian VCs and Indian angels are so worried about equity. I don't understand it, right? So while you guys worry about your equity rounds, I'm going to come in and take your deal and do a convertible round. So while you guys talk about your terms, I'm just going to do it, right? And you should too. It's okay. If your convertible note has a cap on it anyway, it effectively behaves the same way. And anyway, remember I said earlier that the first check isn't designed to give you all the return anyway. The first check is just to get you a seat at the table for the next round. And then you can worry about equity at that point. Once you have like some seat at the table, then you can talk about equity. But at the earliest stage, just do a convertible note and get it done with. Let the founder get back to work. Lower legal fees. They're very quick to execute. I'm actually doing a convertible note with a founder here right now. I'm doing a deal in India right now. Actually, I'm pushing the paperwork through right now. It's a convertible note, right? And I can just wire the money today. It's easy. So don't waste too much time on equity. Standard docs are your friends. I was at an angel group meeting. I don't want to throw anybody under the bus, but I was at an angel group meeting. You probably know who I'm talking about. I'm going to just say in Mumbai or Delhi, and you guys can figure it out. And right before the meeting, they had to sign documents. Now, this is not their fault. This is the Indian legal system. But the fucking closing documents were like this thick, right? Unbelievable. Unbelievable that people would do that. Part of that reason, let's put aside the policy, the Indian policy, like the Indian government and the reporting requirements. The fact is, I bet most of that documentation is because they had this custom deal with every founder, right? If you agree with me that you have to have a thesis, then you have to agree with me that part of that thesis is you have set terms, right, that don't deviate much. Sometimes they'll deviate, but you don't want to deviate on the material terms. I'll tell you what I deviate on. But when in doubt, do not innovate in finance or legal. Okay? All right, so if you do a deal, these are the only two terms that you must have any terms you want in there, but I would encourage you must make sure you have pro rata and information rights in every deal. And founders, if you don't allow for this, you're kind of an asshole. I will not do a deal without these. All right, so just so you understand what this means, let's start with the bottom one first. Info rights, information rights, just give you the legal right as an investor to say, hey, how's it going? Right? And my terms say that you must send me at least a quarterly report. So I don't want to be too burdensome, but I at least want you calling home once a quarter. My hope is that because I add so much value, you'll call me every week. And I'll tell you later offline about how we get reports from our companies nearly weekly right now because we add so much value. And that's not even contractual. But the other term is pro rata. Now, this is really, really materially important, especially to angels. For the angels here, you're probably worried about VCs because you're worried that we'll cram you down. Meaning that in a subsequent round, when the company's doing really well, I'll say, F these angels, right? They didn't do anything. I'll just push them down. I'll dilute the hell out of them. You want pro rata rights in there because it makes it harder for us to do that. But more importantly, it gives you the ability to put more money in to hold your position. That's what pro rata is at its core. I'm simplifying, but that's what it is at its core. If you had 5% of that company in the first round, when that next round comes, you have the right to put in a minimum amount to hold that position. It doesn't mean that you can buy up. That's between you and the founder. That doesn't mean that you can put more money in and get an extra % or something. That's between you and the founder and the deal. But what it does is it actually protects you on the downside. So that if the VC is coming in and saying, no, I'm not letting any of the angels put more money in, at least you have the legal right to hold your position. Right? And founders, a lot of founders don't want to do this because they'll say, well, I don't want to cause any problems for, during the later stage. I don't want to tell the VC that they have pro rata rights. And to them, whenever a founder says that to me, I'm like, look, first of all, I'll walk you through the magic of why this is important. But secondly, I hope that you say that to me. I will be interested to see if you say that to me when you become an angel. Right? Because we probably all know people that made money on a deal but could have made far more if they were allowed to put more money into subsequent rounds. I know lots of deals like that, actually. And we got crammed down. We, as a VC, got crammed down on a couple of our deals, and that's why this is there. So again, these are the two things that you must have in your term sheets whenever you do them. The next thing I really encourage investors to think about is don't think about the percentage that you own. That does play a part in your thesis, but on a tactical level, a deal-to-deal level, what really matters is the valuation and the multiples of your money. Right? So like for me, in a subsequent round, I won't put more money into a company unless I can see at least 3x return on that money. Unless if I can see, okay, this business is going to be able to get a 3x return on that money, right? So I'm not suggesting, just to be clear, I'm not suggesting that percentage ownership doesn't matter. I'm just suggesting that if you focus solely on the percentage ownership, you're forgetting the other side of the coin, which is if you're in this business for returns, the multiples really matter, right? Because the dirty secret, by the way, of exits is that the number that's always disclosed is the number that the company was paid, that the company got. So for those of you familiar with acqui-hires, right? Acquisitions, just like small acquisitions just to hire the team, right? The problem with those acqui-hires is typically that the market will say, oh, yeah, this company got picked up for 10 million bucks. What they'll forget to tell you, because nobody wants to admit to the dirty secret, is, oh, yeah, by the way, 9.5 million of that 10 million went to the founders as earnouts over the next 4 years. The investors only got 500,000 for the business. That's why percentage on its own doesn't really tell you the whole picture, right? So my point here is look at the deal holistically. Percentage on its own doesn't matter. Multiple on its own doesn't matter. But together, it's meaningful. Now, in the U.S. anyway, we are seeing valuations that are exceeding 5 million on early stage deals. What I tell people is there's only 3 options. When a deal gets expensive, by the way, this is actually really interesting. You know, when I first started coming here, so I come into the country every 45 or 60 days now, and we have somebody on the ground full time here now as well. But when I first started coming here, one of the concerns that other angels had and other VCs had was they said, well, Paul, I'm worried that you're going to raise the pricing. And I'm like, well, look, I'm kind of actually flattered because I didn't think I could actually move the market like that. But the fact is that the best founders, right, the paradox of investing is that we all want to be in the best deals, but the best deals don't need us. In other words, the best deals will be expensive. They will be expensive, right? Now, if they get expensive, you only have 3 options. Option 1 is that you walk away. You just say, hey, I don't do deals that are north of 4 million or 5 million or whatever it is, right? You could say that. But if you say that, then you won't even win the lottery. If you don't buy a ticket, you're not going to even have a chance of winning the lottery, right? So that's option 1, walk away. Option 2 is that you can say to the founder, you can complain about it. You can bitch and moan, you can do all this stuff. But here's the bottom line. If it's a good founder doing really good stuff with good traction, all you've really done is lost your breath and probably hurt your brand. Because that founder will talk, and you just hurt your deal flow in the future. So that's option 2. You can complain about it. And option 3 is that you innovate. That you behave the way that you expect your founders to behave. When they hit a brick wall, they have to innovate around it, right? So we should too. The way that I do it, which doesn't mean it's the right way, but the way that we do it is on our convertible notes, we just put a minimum return requirement. We say on our documents that, hey, look, okay, fine, you want to do a $6 million valuation? I'll tell you why I don't think that's a good idea, but if you want to do it anyway, that's fine. But if you try to sell the company before the note converts, okay, I want 2x my money back. It behaves like preferred stock in an equity round, but as I said earlier, I'll do equity if I have to, but like I'd prefer to do convertible because it's cheaper for me anyway. But the point is, I also don't want that right forever. I just want it until the note converts. Because my assumption is by that time when it converts, there will be an equity round, right? Or I will have equity in the company. So my point is, again, that I'm not suggesting that you do exactly that. I'm just saying that we've innovated our way around that problem. I hope you guys do too. Because I think the fact is that as Indian founders become more good at building good online businesses, what's also going to happen is more investors from the U.S. like me are going to be here, right? And if the fact is the market will change. It's just going to change. AngelList, by the way, you should all be on AngelList, founders and VCs, and angels. I always say to people, like, if you're not on AngelList globally, if you're not on AngelList, you're either an idiot or you have something to hide. I'm being very blunt with you. You're either an idiot or you have something to hide. And either way, I don't want to fund you, right? But that also gives you visibility into deals. The bottom line is for investors here in India, let the founder get back to work. Let the founder get back to work. At the earliest stage, you don't know what's going to happen. You don't know, right? The due diligence actually happens in the rearview mirror. Like I said earlier, we're actually bringing on venture partners now as part of our investment team. One of the things I say to them first when they come on board is I say, look, this is a long game. Never, ever, ever put your reputation in jeopardy over 1%. At the end of the day, like one term, if one term on your deal is wrong or something like that, as long as it's not material like prorata and info rights and all that stuff, just let it go. Let it go. Just let it go. You just want to be in that deal for the first check. You can negotiate later. Just get in on that first check. Okay? But the bottom line is get the deal done. The burden is on the investor to let the founder get back to work quickly. Right? Remember I said earlier that I want to be an API to venture capital and functional expertise. What I mean by that is, for example, when I invest in a company, I'm going to call all my friends. I'm going to help you raise that money within days. Right? I'm going to run demo days. I'm going to be the #1 investor on AngelList. We're the #1 followed people on AngelList. Right? It's not because we're egomaniacs. Maybe we are a little bit, but there's a reason for it, which is when I do a deal, I get lots of eyeballs on it really fast. I create a market for my companies. You should too. Right? Avoid board seats. This is always controversial, especially in India. I don't understand why. You know, Chamath was, he did a speaker dinner, I think, last night or the night before. He said something I thought was really interesting, which I think not enough investors say. So it was really refreshing to hear from him the same thing, where he said, like, look, my last exit, or well, I won't phrase him, but he said effectively the same thing I'm going to say. I'll just say, look, my last exit was in 2009, right? And even though I'm investing in the same verticals that I was involved in, the fact is that a lot has happened in 4 years. What can I possibly do to help an early stage company move the needle forward? What can I possibly do? My point is that the core customer acquisition channels have not changed in 4 years. What has changed is as more startups get online, those channels are getting crowded, which means you need better, recent, tactical help for those companies, not hand-wavy strategic advice, right? So avoid board seats. Now, the point is, when you get to that next round, then you talk about a board seat, right? But for the first check, just get in, let them get back to work. Like I said, most boards provide minimal value add. Here's the dirty secret. The best deals don't usually need your help anyway. Let's let go of the ego, right? Let's just let go of the ego. We don't add value. I tell everybody that, like, we cannot influence the outcome of our companies. All we do as investors is accelerate the ultimate outcome. The default state for all startups is failure. Agree? Okay, so the only person that can actually change that state is the founder. All we do, investors, is we're just the accelerant. Whatever's going to happen is going to happen. The best deals won't need your help anyway, but it doesn't contradict, because I want some sort of data. I also want the founder to get used to thinking about an iterative approach, a data-driven approach to their own business. I always tell my founders, like, whenever they say, like, I think or I feel, so I'm on the Myers-Briggs, I'm an ENTJ, right? So I'm like the field marshal. Like, if you want to rile me up, just say, like, I think you're wrong, or I feel. I'm like, no, fuck you. Show me the data, right? Because until you show me the data, my data says that I'm right, right? But here's the thing, investors. And I don't know. My mom always said this to me, I think, when I was growing up, and somebody in your family probably said it to you too, which is most people will never remember what you said to them. They'll remember how you made them feel. Does everybody agree with that? All right, so when a founder calls you, one of the things I always say is, like, look, nobody ever calls a VC to say hello. This is the loneliest job in the world, right? Because, like, when an investor comes over, like, hey, I'm like, oh, what deal do you want me to look at? Right? When a founder's like, hey, how's your family? I'm like, oh, you're just bullshitting. What do you want? Don't stop talking to me, by the way. But I'm just saying, the point I'm really trying to make is when a founder calls you, they call you at the extremes of emotional states. They're either really excited about something, hey, I got this acquisition offer, or man, I'm going to hire this guy, or something. Or they call you at the low point. My wife's about to leave me. My kid's sick. This deal just fell apart, right? It's not important what you say to them. It's important that you pick up the phone. One of the things you'll see about me is that I'm always online. I got my laptop, I got my iPad, I got my phone, I've got data coming out of my ass. I got 3G connections everywhere, right? And the reason is, by the way, LTE in America now has me so spoiled. Like, I come here and I'm 3G. It's like, It's super slow. It drives me nuts. LTE is awesome. Anyway, the point is just answer the phone. When they call, when your founder calls, like I'm on the phone right away. If a founder calls, immediately pick up. And it's either, oh, here's what I think, or hey, listen, I'm just about to give a talk right now. I tell you what, can I just call you in an hour? That is all you need to do. All you need to do. And because of things like that, they will never forget you. And when that next deal comes, and you're about to get screwed because like some bigger VC wants to push you down, maybe that one favor that you did will help push that founder back into your court. The other kind of thing that I'm saying underneath this is, if a deal goes sideways on you, don't try to step in and fix it. Your time as investors is better spent sourcing new deals, not trying to like fix one. The number one mistake you can make at that stage is to put too much good money after bad. Right? So, again, do not innovate in finance or legal. The key things I want you to understand is that investing is a process. Right? First check is fast, it's small, it's just designed to get you a seat at the table. If you're just dabbling in investing, if you're just doing 3, 5, 10 deals or whatever, eyes open. That's okay if that's your thesis. The bottom line is admit to yourself that investing it's no better than just gambling. Or you need to give it to somebody else to manage no better than just sitting at the roulette table or the craps table. And that's okay as long as you go in with your... be an active investor, which means like you got to do a lot of deals. You need to read about the industry. You need to know about lean startup. You need to know about the trends in the industries you're investing in. You need to be a smart investor. Focus on information asymmetry, which means that, in other words, like make sure that you're asking other industry experts about a deal before you do it. Right? The Kauffman Foundation says that returns are actually 2x for somebody that actually has 14 years of experience in a particular vertical. Like if you're investing in that vertical and you have 14 years of experience, your returns are generally 2x. Right? So, but that's information asymmetry. Get somebody that's been in the industry to tell you that that's good. That's actually one of the reasons why we only do referrals. We only take referrals. Founders, by the way, you can pitch me all you want. I'll give you feedback, but ultimately what's going to happen is, even if we're interested, I'm going to punt you to one of our mentors or founders that has some sort of industry expertise, and I'm waiting for an opinion. Right? In angels and VCs, you should be doing the same thing. So this is my favorite quote from Michael Lewis's book, Moneyball. Right? And this is the underlying reason why I can stand here in front of you, being relatively young and being 2 years old. And that is, by its nature, the internet undermines anyone whose status depends on privileged access to information. Everything that I told you is not, like most of it I didn't create. I'm standing on the shoulders of giants. I've picked a little bit of here, a little bit there, and built a thesis around it. You can too. All this information is online. All of my slides are online. All of our terms are online. All of our demo day. Founders, by the way, I don't understand why you guys make all the same mistakes in terms of pitches. All of our demo day videos are online. All of our slide decks. Every company, there are no stealth companies at 500. All their decks are online. The point is that we're giving all this information away in the hopes that you guys take it and do something even better with it. Right? Again, the idea I want to leave you with is that everything we've talked about here is, it's all kind of threaded together by this idea that we must all be an API to venture capital and functional expertise, regardless of what side of the table we sit on. Again, these slides are online. I'm pulsing on Twitter. The link is on there now. You can email me anytime. I'll be around till Friday morning, and my personal blog is up there as well. I really appreciate the time. And I hope this was useful for you. I don't know how we're doing on time, but if you have questions, if you guys have any questions, I'll stick around. Or anybody have any questions right now? Good?
Say you're a big investor and you have a huge portfolio of companies to invest in. Do investors invest in to get a cool factor so this company is doing great work, but there's no monetization?
What's your question?
In the sense, it's like a cool idea I have. It's a cool idea I have, but there's no monetization plan I have. But
Well, I got to make money. I got to make money, right?
So you already have so much, but there's only valuation that comes from, like, say, there's a hope that it gets sold.
Oh, so you're saying, what if you focus on growth first?
Yes.
That's fine. Look, there's some industries where you have to focus on growth first.
Because there's a lot of, I mean, the general trend we have seen is only the online portals or online mobile apps get invested. There's no B2B or the technology companies. We rarely hear about them getting investment.
Well, the way that I would answer that question is, let me answer it India specific first, right? Well, let me actually make a contrast between, for example, the U.S. market and the Indian market. In the U.S. market, so I would say the Indian internet scene looks like what America did about 10 years ago, in the sense that the consumer market was just coming online. It wasn't clear if they were monetizable yet, but there were definitely more consumers online than businesses, right? So that's one of the reasons why, like probably 10 years ago, you were seeing a lot of investment that was, focused on eyeballs, number of people using the site. But over time, what happened was that the SMB and the enterprise market started to come online, and we were able to monetize sooner. Also, the consumer side of things really got more comfortable with buying online, right? Now, India, I think, India is a little bit different. It's a little bit earlier, right? Depending on the stats and who you believe, roughly 100 million people are online here now, and regardless of who you believe, I think in general it's safe to say that that number will be 4 or 5x in the next 3 years, right? But what's more interesting than that number is actually the fact that underneath that big number, there will be an increasing, I think, comfort level of consumers to pay for something online. Let me just stop rambling. I would just say that I think, look, there's just going to be a lot of growth, like consumer-focused companies in India first that are going to have to grow first. I don't know. There's just, I want them to monetize, but I don't think the market's ready for it, right? Don't get me wrong. If I'm looking at 2 deals, but one is monetizing sooner, then from a risk standpoint, I'd rather just give the money to the person that's monetizing. That's actually the challenge. I think founders, you need to understand what you're up against, right? So one of the real reasons you should be on AngelList is because it tells you who else is raising money. So what you should be doing, for example, in angels and VCs, you should be doing the same thing. When you're investing in a certain vertical, and founders, if you're in a certain vertical, you should go on AngelList. You should look at the categories tab. So if you're, I don't know, gaming or something, click that tab. You're going to get a list of startups. Sort it by the number of introductions. Does everybody understand why? Because you're looking at their profiles to understand generally, who else is raising, and what is it perhaps about their public profile that's getting people interested. So back to your question, I would just say that the real challenge, so the good news for you is, I assume you have a consumer-focused, growth-focused company. The good news for you is that I think most investors might agree that that India will be a growth-first story on the consumer side. The bad news is that there's probably other startups in India that are able to monetize sooner because maybe they're serving a different market or something. And unfortunately, when you look at that deal simplistically, just take the less risk approach, right? That's the bottom line. So last question, and then we gotta, last question. Make it good. Otherwise, all these people are going to be angry at you.
So I've been starting a company. It's been there for about 2 years. They're basically a social search-based e-commerce company. So if you know AdWords, which is required by
Sure.
so we're combining that with the daily deals in commerce, and that's the old approach. So ours is not a viral-based company. It's more in terms of engagement and revenue per user, so it's commerce-based. So it's been some time. My question to you is, when do I look to pivot? Because there's a lot of demand for services from businesses, small businesses who want a digital model in place. So I look at revenues after about 2 years of putting money in the product. Do you suggest that you go all out with the product and go the last mile, or do you pivot and fund the product?
Well, yeah, I don't know. I think, look, my directed feedback, or my personal opinion for you is that you should never ask a VC for an opinion. In all seriousness, here's the thing, right? At best, I have incomplete data, right? Unfortunately, only you have a complete understanding of what's going on. Now, here's what I would give you as food for thought. You're talking to a VC, which means that I'm biased towards companies that can get us the returns that we want to see. Let's say 20, 30, 50x returns. That would be superb, right? In the context of that, then I would want you to shy away from the services side of the business, right? As a human being, Don't ever raise money from a VC. As a human being, like we are blood-sucking. All of us, all investors are blood-sucking venture capitalists, right? Human to human, founder to founder, don't raise money. Monetize and bootstrap on your own because, like you only want to trade. So Paul Graham, who runs Y Combinator, one of my favorite statements from him is he says, and I'm totally paraphrasing here, so I doubt I'll be, I don't know. But anyway, he says you should only ever trade equity if you think that the money that you're going to get for that equity will grow the business by more than the equity you gave away. So if you gave away 10% in a round, you better make sure that that money wasn't for vain because you want to make sure your business grows more than 10%. In general, the rule of thumb, I usually say to founders two things. You always want to raise 12 to 18 months of runway, and you only really want to give away about 12 to 18% of your company. That's a general statement, so don't follow that, and investors don't screw me or crucify me. But the second thing is like think about like when you take money, it's for growth only, not for building your product, not for doing anything else. It's only for growth. Only for growth. That's it. Like